Glenn Rufrano, shares of your company, VEREIT, are up over 30% so far in 2016, certainly outperforming the IYR, which is the ETF that tracks publicly traded REITs. You have a little bit of a different story because of a management restructuring last year, but still, the shares are performing very well. Why is that?
Well, you've mentioned management restructuring. I would term it a little differently. There were some mishaps in 2014 that the company had, and what it needed in 2015 was leadership and direction. I came on April of 2015, started the leadership, put a brand new board in place, put a brand new management in place, all new corporate governance. And with that leadership, we then put a business plan in place in August of last year with 4 very simple points. Let's cull the portfolio and make it better. We have an investment management arm, cull. Let's reestablish its brand. We lost our investment grade rating. Let's get back our investment grade rating by having investment grade metrics, and let's put a sustainable dividend in place. All those points were put in place, and we are executing.
And about a quarter of your portfolio is in restaurants. You own restaurants, you own retail, you own office. Let's start with the restaurants. One of your biggest tenants is Red Lobster.
Yep.
It's becoming less so. Their share is declining. But it's been a successful partnership so far. Why is that?
In 2014, the company bought $1.6 billion of Red Lobster's, financing it in a Darden transaction. Very good transaction, very well structured, but too much. It was 12% of our revenue, which is just too much. We care a lot about diversification. We are selling our Red Lobsters and have successfully sold a number of them. We sold $420 million last year. This year we will continue to sell those assets. We'll bring the ratio down over time, but it has been successful. Red Lobsters have been up each quarter for the last 6 quarters in sales. We're happy with the portfolio. We just need to have a little less.
And in retail, a lot of your properties are Walgreens and CVS. Now, you can't turn around without seeing a drugstore anymore. Are we seeing too many? Are they starting to cannibalize their own business?
There are some consolidations going on. For instance, Rite Aid was bought by Walgreens. So consolidation is happening in that business, but it's a very attractive business. It's necessity shopping. They're on fine corners. We like the real estate. We're happy with the business. We're happy to have them.
And one of the hottest sectors out there in terms of retail is the dollar stores. You got Family Dollar, you got Dollar General. You have to be pleased with that as opposed to owning department stores, because when I speak to REIT operators and mall operators, they're tired of the department stores not doing well for them.
Well, department stores have lost market share for 20 years. You know, we're in an era now where necessity shopping is important. People want value. Dollar stores present value, as does TJX, another big tenant of ours. So we're happy with necessity shopping, and those portfolios are doing well.
And about a quarter of your business is in office. You own office properties all around the country. Real estate comes back, of course, to location, location, location. So what are your hottest locations for office?
You know, first of all, our office is mainly corporate campuses. So if you look at our office, what we care about is not only location, but credit. 65% of our tenants are investment-grade tenant in our office portfolio, and they have very good corporate campuses. So it's the combination of 2 that we care about, and we're in 49 states. You know, so instead of identifying locations, I would tell you we have very good nodes for transportation for many of our office campuses, and our tenants are doing well.
And then finally, one of the reasons why REITs are doing so well in 2016 is because of this low-yield environment. Your dividend is a little bit over 5%, off the top of my head.
Yep.
So what are your plans for the dividend?
As I said, our 4th pillar of the business plan was to put a sustainable dividend in place. We had not been paying a dividend in the first 2 quarters. With the board recommendation, we authorized a 55-cent per year dividend. We think and there's plenty of cash flow coverage. We like that. Our coverage ratio is approximately 70% of AFFO. Over time, we'll watch that dividend. We first want to make it sustainable. No question that it's going to get paid. Now we'll think about growth.
All right. Well, thanks a lot, Glenn.
Thank you.
Thank you for watching The Street.